Hello, thank you for tuning in. It is Dan Kurz of DK Analytics. It is December 18th, 2018. Um, I want to share some thoughts with you on the central bank, global central bank behavior front, monetary policy front. And before I do that, two things of note. First and foremost, I want to wish all of you a very Merry Christmas. Hopefully, you will have all of your family members and close friends at your side for this truly hopeful occasion, the birth of Christ. And secondly, I would like to wish all of you a very happy, most of all, healthy, and also prosperous 2019. As you may be aware or may not, we've suspended all publication efforts short of videos. That is, as of late October, no more posts or reports pending a reset of certain asset prices, which will allow me to carry forward efforts here without financial considerations playing a major role. But our effort today here in this video is going to focus on global central bank QE morphing into global QT in 2019. The Chinese say a picture's worth 1,000 words, so here's a chart courtesy of the FT on just that. Let me see if I can get this focused well here. Yes, what we see here in this chart is that globally we went from over 2 trillion, actually up to 2.5 trillion in QT, 2 trillion as recently as 2017. And what is QE? QE, that 2 trillion plus, is central banks creating money out of thin air and using it to purchase bonds, especially government bonds, even corporates, in some countries stocks like Italy and such as Switzerland and Japan. And what we've done is an about face the reduced asset purchases of the Fed ending a few years back and now being followed by the ECB are taking us into a world in which instead of $2 trillion a year of artificial demand for bonds and stocks, and by extension real estate, which is very interest rate sensitive, we're going into a period led by the Fed of quantitative tightening. That is sales of assets led by bonds, treasuries, mortgage bonds, and this is resulting in a world where from 2 trillion in asset purchases to minus 600 billion or 600 billion of sales is a very stark change of 2.6 trillion per year in terms of demand for assets, and as such has been a wonderful put underpinning the value of even junk bonds, be it corporates, be it sovereigns or government bonds, very much including the much maligned Italian government bonds. And here's where this, I think, gets interesting. And I might take a moment and state that I called this out in July 14th of this year in post 42. The title there was "If QT keeps ramping up to 600 billion per annum," talking about the Fed, look for an accelerated reset. The reset means entirely different asset values or valuations, rather, specifically of bonds, stocks, and real estate. A popping global asset bubble, which a huge shift in magnitude of 2.6 trillion a year within 2 years is going to help precipitate, or aggravate or deepen or all of the above because the demand for these bonds is that much lower, right? And we have a tough situation, as I'll get into here briefly, financially, economically, and politically. Situation which does not favor maintenance of capital, real returns on invested capital, and other such good stuff, which drives at the end of the day an economy that is proceeding towards greater productivity, wealth of nations, and all the things that we came to love but are now sorely lacking and has been papered over by the printing press. But this global popping asset bubble, as we've already seen in emerging markets and are starting to see in developed markets, will be effectively reflected by increasing liquidity constraints, mainly or most of all QE from QE to QT. Quantitative tightening simply means sales of bonds by central banks, sucking up and drying up liquidity instead of providing it. Rising counterparty distrust associated with the same. Vaulting deficits, both public and private. Sharply rising global debt. We're at over 250 trillion. Global debt saturation. We're at 3.1 times global GDP. And eventually crumbling fiat currencies in which our unpayable debt edifices are based. Examples. Hello, technically insolvent governments and their bubble bonds. I'm referring to countries such as Italy or Japan, where the public sector debt to GDP is between 130 and 200%. I'm referring to corporate bonds. For example, in the US, where over $2.7 trillion in new debt has been added to balance sheets, a towering $6 trillion plus level, and most of that has been used to repurchase stocks, do M&A, instead of investing in organic top-line growth and competitive product portfolios. And by the way, the spread between corporate S&P style or investment grade corporates and the Treasury is still very low, although we've got lots or increasing corporate distress even amongst blue chips or erstwhile blue chips, as aptly identified by GE's trajectory into the mud and followed by extension by too many other companies, as proven by the massive amount of debt increase in stock buybacks. For more flavor, also consider mortgage bonds, where both rising benchmark interest rates, yes, we've had a pullback, but we're still much higher than we were a year or two ago. We also have increasing non-performance concerns dead ahead, thanks to spiking financing costs in this huge interest rate sensitive sector, real estate globally. And given a long-standing global real estate overbuilding boom, itself fueled, as you know, by artificially low interest rates, courtesy of global financial repression, QE and ZERP and NERP, it should come as no surprise then that in fact, central banks, in trying to restrain for political reasons, corrections in the cyclical market, real estate, have blown an ever bigger bubble, which ultimately has to pop and is starting to pop with huge implications given the weight that real estate has from building to sales in economies. It's one of the biggest, if not the biggest sectors. That is now unwinding, popping from leading Australian cities to London to San Francisco. Meanwhile, prior to any onset of an official recession anywhere in the globe, at least in the OECD country realm, And prior to market broad-based meltdowns of either domestic stocks or bonds, US stocks or bonds, much less a reversion to interest rates, which offer much better creditor protection against both insolvency and or financial repression induced inflation, the huge increase in a monetary base. Unrealized losses of leading banks in their securities portfolios at what are supposed to be rock solid institutions reached the highest level since 2009 in Q3 18. And remember, we don't have a broad-based meltdown in securities, certainly not in the US. Yes, these banks have held some emerging market paper, but most of it is US based, yet we still have these kinds of losses, all right? Let me see if I can get this on the screen here. Well, bear with me one moment. There we go, or on the camera rather. You see, we went from gains for quite a while as QE was chugging along, obviously, to now stark unrealized losses. And let me also touch on why this is not just an academic thing, right? The reason it's not academic is because at some point these banks may have to sell these marketable securities. And I'll get into that in a second. But do note, if you would, that the stock market, Mr. Market, is voting with his feet in terms of getting out of harm's way as regards the financial stocks. This is really important because of one thing. We have had a financialization of the world's economy. That is, a move from a lightly indebted to a heavily indebted global economy. And financials are leading the stock market lower. The enablers, if you will, together with the central banks, are leading the stock market lower. Not exactly a confidence-inspiring development amidst our heavily financialized world. The chart here that I'd like to show to depict this is right here. All right, S&P 500 financial index change. Whoop, you see it leading on the downside, the decline of the overall stock market. And when your financial stocks fall in a financialized world to the tune of 22 or 23% in the space of less than a year, then that's not exactly a confidence-inspiring indication of where we're going. In all, these developments point to a potentially disruptive financial institution balance sheet situation. Namely, should liquidity / funding issues deepen amidst banks' perpetual asset liability mismatch, borrow short, lend long, this could force asset sales, such as of marketable securities, which are under pressure, and we haven't really even started the decline in valuations in the US. I have to repeat that. But this could force asset sales at distressed prices. So it's not academic what happens here. And when your equity as a financial institution, a bank of sort, a bank, if you will, is when the equity is but a sliver of your balance sheet, 8% or so, it doesn't take much for insolvency or bankruptcy to beckon based upon loan losses, write-offs, and forced sales or liquidations of marketable securities under stress. simultaneously, and very, very important, because this explains, as I've gone through, why we've had to take on so much debt relative to GDP growth. Our debt growth globally has been about 3, 4, 5 times as high. If you go to the last year or two, it's arcing over 3 times, because we have had fading global productivity. And that fading global productivity is not just due to an increasingly difficult environment in which to procure dense energy, despite the current reduction in the price of oil. It's a fact it's getting harder and harder to find it and more expensive to pull it out of the ground. But I digress. Let me get back onto the other aspects that have been maligning productivity, and they are long-term entrenched, and they include cronyism, redistributionism, statism, perpetually bigger unrepresentative government, and the bureaucratic maze. Consider the cost of regulatory compliance in the U.S. economy at a unbelievable $2 trillion a year out of a $19, $20 trillion economy, about 10%. And also, productivity is under duress, thanks to property right transfers related not only to the property being transferred either through bad money, either through taxes, either through regulations to cronies or to bureaucrats, but they've been transferred at an increasing pace throughout the OECD, actually, to third world amnesty programs that OECD nations have been conducting. And as a result of all these things, which tie together and in essence weigh on each other over time, we've reached something like a 30-year low point in global productivity. In 2018, it looks to be coming in at a practically non-existent 0.17%. On the developing nation front, despite all the hoopla, we've actually seen, especially in China, dependence on factor mobilization more than on replacing labor with machinery or getting real productivity, leveraged economic output, as record amounts of women have gone into the labor force and people have come from rural areas into urban areas. And amidst a rapidly aging Chinese society, and this has, in one way or another, in India, through the bureaucratic hardening of the arteries never stopping, in effect rendered the hope for productivity advances in the emerging market less than spectacular, despite all their other achievements. And combined with OECD productivity, we get a global productivity number that keeps on heading towards zero and might even turn negative, which means you produce less with the output or with the input factors that you have available. In terms of property right transfers to third world immigrants, something that one has to stop or could stop if the politicians deem it important enough and people vote enough politicians that hopefully do the representative bidding of the citizens that they should. But in the US, consider, for example, to put a number on this, that the average taxpayer subsidy of a third world immigrant person is $70,000 a year, $70,000 a year. This is spent on things such as additional welfare costs, additional schooling costs, additional housing costs, language complexity costs, free medical care, including delivery of lots of babies, increased utilizations of hospitals and police forces, and on and on. Now, that is a lot to pay, I would argue, for a Latino yard worker or a produce harvester. Suddenly, they aren't as affordable. Why? Because they bring an extended family of dependents with them. That's why the average immigrant bill or taxpayer subsidy is $70,000 a year in the U.S., and I doubt it's much different in Europe. And by the way, welfare is about 70% of the average immigrant population, which nowadays is third world Latino immigration in the U.S. About 70% of those immigrants receive government assistance, welfare, if you will, versus a fraction of that, something like 25% of Native Americans. And as I said, it's much the same in Europe. We know that, well, I know based upon having lived in Switzerland, being bilingual, having South German connections, knowing what's going on in Switzerland, and by extension also being familiar with what's going on in London and the UK, thanks to a close connection to an excellent analytical person that I've known for over 10 years, that is also taking place in the UK. So we have a transfer of property away from citizens to massive third world amnesty. And as a footnote, and I'm not trying to be cute here, but the most popular male birth names in London and Paris, which might have been George or Gabrielle, are nowadays all too often Muhammad, and that's a preview of coming societal makeup attractions. If we tie all this together, why is it so important? As credit spreads inevitably widen, portfolio losses swell, and liquidity dries up, we go from QE to QT. And why is this important with a globe saddled with $250 trillion in interest-bearing debt, or over 3 times global GDP? The reason is deceptively simple. OECD, Western countries, cannot finance cronyism, redistributionism, statism, and sustained massive third world amnesty, which are all Main Street maker property right eviscerations and outright property transfers of unmatched magnitude that end up killing the free market capitalist goose that lays the wealth of nations and individual freedom golden eggs. That is, OECD countries can't do this without the currency debasing printing press artificially holding down the cost of external financing, of debt financing, because collectively we're no longer capable of generating the free cash flow with which to sustain our growth. With central banks upping interest rates and selling bonds instead of buying them into an unparalleled global debt edifice at an unmatched 3.1 debt to GDP level and an expanding ocean of financing needs, expanding deficits, which a recession will only amplify dramatically, borrowing costs for households, financial institutions, corporations, and ultimately governments are set to rocket higher to reflect much higher near-term illiquidity, budding insolvency risks, growing counterparty or interbank, your assets are no good or not liquid kind of risks, and the latent monetary inflation risks that are part and parcel of a massive $16 trillion plus global monetary based expansion since 2008. This, ladies and gentlemen, is how a global financial tsunami starts, or hurricane. We saw a milder version of this with considerably less debt, about 75 trillion less, and less financial repression. We started with higher interest rates and didn't have huge, and had 16 trillion less in global central bank balance sheets than we do today. And we also had a less toxic public policy stew, free market capital destructive, in '08 and '09 than we do today, with our uh, with our added emphasis of more cronyism, more redistributionism, more statism, and more third world amnesty. This time around, with that debt about 80 trillion higher, which is, by the way, the equivalent of 1 year's global economic output, not a small number, uh, our interest rates, despite this snapshot, are still near record lows in most OECD countries and are still near an all-time low at the discount rate level in China. Yet we are sliding into a global recession with Japan and Germany leading the way with negative growth tallies at the real GDP level in Q3, and the rest of the world not far behind. To add insult to an economic slowdown situation, a lot of companies have been building inventory. You guessed it. You know why? Ahead of, well, what is looking, depending upon which day you look, but I'm going to say this is a political war in addition to an economic war. They're tied at the hip. But it is looking like an increasingly intractable and burgeoning trade war. So companies have been eager to purchase pre-tariff price increases goods that they will then in turn manufacture, configure, or resell onto their customers. Well, with global inventory levels at artificially high levels amidst globally weakening economies and vanishing productivity growth, it is looking like a perfect global recessionary storm, especially when juxtaposed against this year's trade war-induced inventory build or bloat, which is lacking top line or sales follow-through. This budding reality, I would argue, is dangerously weighed down with more geopolitical insanity on behalf of the Trump administration, which recently saw fit, as you well know, to orchestrate the arrest of a Chinese CFO. Her name is Meng Wanzhou, if I'm pronouncing it correctly, who was engaged in Canada on behalf of either the biggest or one of the biggest telecommunications companies, namely the Chinese giant Huawei. I apologize for mispronunciations. She, the CFO, was arrested for allegedly conspiring to sell Chinese telecom communications equipment containing U.S. technology to Iran, which Trump administration officials claimed was in violation of America's policy of Iranian trade isolation. Well, America's efforts to bring nations to heel, to in effect superimpose its own laws to displace other nations' laws, from the Chinese CFO example to grotesque FATCA overreach, to banning nations from the international payment system known as SWIFT, which happens to feature the dollar as the core currency, is increasingly goading nations to seek alternative payment systems and currencies, threatening ever more greatly America's global reserve currency privilege, and thus its artificially high, quote, we can print the money to pay you or just issue more debt, unquote, way of life. With the rest of the world financing America's $600 billion plus widening, Mr. Trump, widening net trade deficit, while America owes the world over $8 trillion, is a net debtor of over $8 trillion. This is not, I would argue, an idle concern. To distill this all down to a bottom line, I'm going to say that all this, and I might sound like a broken record, but so be it. Facts are facts, and sunrise happens every morning. It might be boring, but it's true. These facts, these economic facts here, in my opinion, are also very true, but they are not reflected in the asset prices that I mentioned. In any event, the financial, economic, and political instability that I hope I've referenced threatens to become the mother or mothers of all valuation storms. And I believe it's nearly dead ahead. We're sailing into it. The signs of distress, as I mentioned, are increasing. And it regards OECD asset valuations that are still at levels that suggest blue skies ahead. Emerging market asset valuations have already been clobbered, as you know, so I take them out of this at this point in time. So what can you expect? What can an investor holding investable securities, a portfolio, expect? I think you can expect a very soon, or in the not too distant future, I'm talking about within a few months, most likely within a few months, a 180-degree U-turn on U.S. short-term interest rates that the Fed controls directly and on U.S. QT, that is back to QE. It should prove to be of unparalleled nature. I'm referring to interest rates which don't go down slowly from 2.5% after the December hike around the corner, or it might even be happening as I speak, but I think it's a shoo-in. We're going to go from 2.5 to 0 all at once. That's my bet. And in terms of magnitude on the balance sheet front, I think QE is going to be much more massive and also broad in scope, including financing universal income. Given our debt-marinated economy, which responds more slowly and less vigorously to more credit creation initiated by monetary base expansion. That U-turn, that total disregard or in-your-face shift, disregard for investors and the value of their investments and the purchasing power protection and the move towards a real yield, this change, this 180-degree shift, I think that is in the cards, can't be avoided because we're not returning to the disciplines of sound money, free market capitalism, and property and respect for property rights. We're just not. And we're obviously not getting back to a government which lives within its means in the United States, as the increase in the U.S. government debt was about 1.4 trillion in the fiscal year 2018, ended October of this year. So we're going to realize that, as investors are going to realize, that the Fed's machinations haven't worked. All they've done is pretend to be machos for a little while, and we're still at a pathetically low interest rate, but they have to shift because we're going to carry forward our toxic public policy stew. And that realization will be that there is no escape, given our political system, from currency debasement and ultimately even much larger negative interest rates. Translation: when combined with our global insolvency, nominal discount rates to value both bonds and stocks, all right, both bonds and stocks, they should go much, much higher to reflect, again, our over-indebted state and the ultimate return to unmatched, unheralded QE, whatever form it takes by the Fed, in an effort to prevent what would otherwise be a debt-induced deflation, all right, which is totally politically unpalatable. And all the pensioners and everybody getting their money, it's much easier to take from them via inflation than to have an actual reduction in pension plan payouts, although they are forthcoming, or reduce Social Security. It's easier to reduce the purchasing power of government payments, which are obviously unaffordable without the printing press and are going to be worth about a fraction of today thanks to the printing press. But that's more manageable and politically less insidious. The people will realize it less, but the end effects will be an inflation-based insolvency or a massive reduction in purchasing power. But that can be gotten away with by politicians interested in 2 to 4 year election cycles. So we could reach nominal interest rate levels which pierced that of the stagflationary 70s and reached their zenith in 81 and September and October reflectively, where 10 in August and September, respectively, where the 10 and 30-year bonds exceeded the 15% yield. While a bear market in bonds is inevitable after a 37-year bull market, it is equally true that unless we get back to sound money, property right protections, political freedom versus PC, and a world run for Main Street makers for contributing citizens, that the only way to carry forward, as I said, crony capitalism, redistributionism, and material third world amnesty is with the printing press. And as takers vote in much larger numbers than makers, unfortunately, this is where we're going. The printing presses will kick back into high gear, but only after enough asset bubbles pop, especially United States asset bubbles. You are, of course, free to see this as you see fit. In other words, believe that this is part of a sinister plan on behalf of plutocrats to strip even more people of assets that they can then repurchase for a song when they're in the basement, reversion beyond the mean. Or you could subscribe to the theory that Keynesian / politically driven central bankers are too stupid to know any better. Pick your poison. The bottom line result, I'm going to argue, will be the same. What all this means for bond and stock valuation compressions will prove to be epic, in my opinion, thanks to the bubbles, the asset bubbles on the one hand, juxtaposed against massive economic and financial distress on the other, from productivity to debt edifices the world has never seen. On the flip side of that, investors will try to allocate a smidgen of their global investable assets, which are currently somewhere between a staggering 250 trillion and 300 trillion, and about 2/3 of that in bonds, into scarce precious metals. That is, investors which collectively have a stake in investable assets of 250 to 300 trillion, probably closer to 250 trillion given markets that have been heading south in emerging world, we're going to see a slight uptick in the interest in precious metals as the ultimate safe havens. In other words, not government bonds, which are nothing other than junk bonds without junk yields. Precious metals, mainly gold, are currently worth about $8 trillion in terms of above ground assets, above ground gold, and to a much smaller degree, silver. They comprise less than 1% of the global investable assets of 250 to 300 trillion, come out of the ground at less than 150 billion a year, about 80% of that gold, at current gold and silver prices of about 1250 and 1450 respectively, are increasingly in firm hands, that is gold. Strategic buyers, including China and Russia, of course, or are dispersed, precious metals, in small quantities in junkyards around the world. Silver, which makes reclamation difficult and expensive. What's the upshot here? Expect global investors to reach higher portfolio allocations in precious metals via higher precious metals equilibrium prices, given dramatic supply constraints. If you move just a small fraction, 250 trillion, into that, you are going to account for 10 years or more of mining supply. And a lot of precious metals, or most of them, are in firm hands. So the only way to get the exposure is by shifting up the equilibrium price. So you still have time. I know I sound like a broken record here, but I think things are beginning to fall into place to sell bubble valuation bonds, stocks, and real estate, and to consider satellite allocations in physical precious metals, as you also move a substantial portion of your proceeds into short-term government bonds, leading OECD nation bonds that aren't interest rate sensitive, very short duration, and can be repaid with the printing press. As a parting thought, recall, if you would, this. We still have 10-year US Treasuries in a 2.85% yield bubble. And the S&P is still trading, despite it coming under pressure, for 20 times the latest four-quarter GAAP EPS, real numbers, including recurring restructuring charges. And this is after an increasingly stout retreat in the S&P 500, including the worst December performance in nearly 90 years, as in right here, courtesy of Bloomberg. There we go. All right. So this is indicative, I would argue, of the vulnerability in valuations of both bonds and stocks, which is all the more true in stocks because the S&P PE of 20 times trailing GAAP EPS is prior to a recessionary EPS compression that is typically around 50%. It could well be worse this time, given all the crap that we have to contend with, as mentioned. And it is also prior to much higher discount rates somewhere on the horizon that accompany a bond bear market. And that, ladies and gentlemen, is a dramatic 1-2 valuation punch coming down the pike at a theater near you before all too long. So I would argue that we have the perfect liquidity pinching, debt-laced storm starting to manifest itself, from emerging markets to stress in developing nations, to weakening OECD growth, to tighter liquidity, and obviously the shift from QE to QT. but that forebodingly quiet eye of the Category 5 hurricane that we're still in much of the OECD world is looking like it's dispersing rather quickly, hurried along, as mentioned, by a shift from global QE to global QT, just as global growth wilts in the process set up to maul the remaining asset bubbles, led, of course, by U.S. S&P 500 stocks, many of which are already in a bear market, but in aggregate not yet, and by U.S. bonds. I hope this makes some sense to you and offers you food for thought that's worthy of your consideration as you take a look at your investable assets, your portfolio, which might, depending upon how it's configured, stand substantially in harm's way. There's still time to do something, but I think it's shorter than ever. That's the message as we go from global QE into global QT. Thanks for tuning in. Merry Christmas and Happy New Year. Bye-bye.